Well, thank you for joining us again at the FundForum International 2012. My name is Daniel Enskert. I'm sitting here with Kathryn Koch. You're a portfolio strategist for Goldman Sachs.
Yes.
You've been with Jim O'Neill now for a while.
Yes.
I think what we're, to go into things in sort of a decade after you coined BRIC.
Yeah.
Where do we stand today with that? So Goldman Sachs views on BRIC, the next 11, sort of the development in the last decade. Where are you?
Yeah. So I work in Goldman Sachs Asset Management with Jim. So Jim did create the BRIC concept 10 years ago as the chief economist of Goldman Sachs. And he has since moved over, and now he's the chairman of GSAM. And that's very relevant because what we spend a lot of our time doing in Goldman Sachs Asset Management is thinking about how to translate these economic concepts and these visions of what the world's going to look like in the future into client portfolios. So how can we create wealth for our clients by investing across asset classes connected to some of these themes? So you rightly identify that Jim and the team created BRIC 10 years ago to identify what we thought could be rank as 4 of the most largest and influential economies in the world in a short period of time. Now, 10 years into that story, the transformation's been quite remarkable. China now the world's second largest economy. As you probably know, Brazil has surpassed the UK in terms of its size of economic importance. So on those metrics of real economic size, as well as performance of capital markets, debt and equity, it's been a very successful decade for BRIC investing. And so you asked a question about kind of where we see the world going over the next 10 years. And we think the BRICs are going to continue to be very important. They obviously are under some cyclical pressures, which I'm happy to take questions on.
Are the BRICs now gone, or is it now the next 11? Because you now talk about, there's challenges in Brazil and in India, etc. China's growth is slower.
Yes.
Do the other ones take over, or is it now a mix of?
No, the other ones won't take over. We think the BRICs are going to continue to be very important. They are under some cyclical pressures, but we think they have enormous amounts of room to move from a monetary flexibility perspective. They have the fiscal flexibility to a much greater extent than the developed markets. So we do think that they're going to deal with these near-term cyclical headwinds, and we think that they're going to continue to be very structurally important over the next 10 years. However, we've kind of broadened our grouping of countries that we're focused on over the next decade to include 4 others, which will not be more important than the BRICs, but really are going to also be quite influential. And those 4 others are Mexico, Indonesia, South Korea, and Turkey. And so together we have these 8 markets, the BRICs, and then Mexico, Indonesia, South Korea, and Turkey, which we call the growth markets. And the way that we got to this list, by the way, is very, very simple and very transparent. There are about 170 countries in the world that are non-developed, but there are only 8 of them that at least have a 1% share of GDP, and those are the growth markets. Now, if they had 1% share of GDP and they were shrinking, that wouldn't be very exciting from an investing perspective, but actually they have 1% share of GDP and they're growing quite rapidly. And so to quantify that for you, over the next 10 years, we think these growth market countries are going to contribute 60% to global growth.
Including a middle class that's growing, population.
Exactly, and so the emergence of the middle class is very important to this story. And we actually think that 2 billion people are going to enter the middle class across all of these countries over the next decade. Now, the way that we obviously create wealth for our clients is that we anticipate these shifts. And so we already have anticipated the shift from developed growth being in the developed world to what we now call the growth markets. And we are some way through that shift, although more room to go. The other shift that we think is going to be incredibly exciting that you've just highlighted is this dramatic rise in the emerging middle class and the impact that's going to have on the fortunes of both developed as well as growth in emerging market corporates. And so that's something that we're spending a lot of time thinking about and reflecting in our portfolios.
Now let's shift a little bit sort of towards portfolios. On the emerging market side, you see still a vast percentage of assets being in equities, but you also see since or post 2007, 2008, more flows going to emerging market fixed income. To the point where now we've seen merging of portfolios where you have emerging market equities with fixed income. So there's different approaches that are being taken to getting exposure to the equity side of it, the fixed income side, some balanced products. How do you see this? What new approaches do you sort of bring to the table, or how do you approach that when you talk and go out with clients? We'll talk about your role in a second on that as well, but how do you see that?
So we think, I guess the headline here for us is that we think that this is an incredibly persistent and transformational trend of shift from developed to the growth and emerging market world. And we think the magnitude is so large that it is imperative that clients actually think about expressing that across asset classes. So across public equity and private equity, and across debt, corporate debt, hard currency debt, which has been around and more known as an asset class for a long time, and then local denominated currency debt, which is obviously becoming more known more recently and diversifying out and becoming a larger opportunity set itself. So my answer is that we think clients definitely need to think about it across asset classes. Some of them are going to want to do that work themselves, but we're also big advocates of portfolios that can successfully blend across the different asset classes. And it's something that we're definitely working on, and we think absolutely has a place in the marketplace.
What's your sort of your new theme of a new global equity, a new way to look at indices?
Sure.
What's the kind of work that you do now?
Yeah. So along with the work that we've already done on actively managed portfolios in BRICS and the growth markets and the next 11, we've also been doing a lot of work in my team on alternatives to market cap weighted indexes. So I'm going to say something that's probably a little bit controversial, but we believe that to a large extent market cap weighted indexes are obsolete. And that's problematic because there's about $1.5 trillion of global equity assets indexed to these in the forms of ETFs, not to mention money that in actively managed funds that's tracking that as well. The reason that we think that they are increasingly obsolete is that we think that there are much better alternatives to get broad equity exposure not using a market cap weighted approach. And we've partnered with SMP to come up with a series of indexes that we call the SMP GIVI indexes, which stands for Global Intrinsic Value Indexes. And this set of indexes aims to achieve broad market equity exposure, but it can do it delivering superior risk-adjusted returns relative to market cap benchmarks. Now, it's a very, very simple thing, and I'll tell you what it is quite quickly. Basically, we recognize that there are some really good benefits of passive index investing, including diversification, transparency, low turnover related to that low cost. Okay. We also recognize there's some serious shortcomings to market cap weighted indexes, which can be summarized by the fact that market cap weighted indexes tend to overweight companies that are overvalued and underweight companies that are undervalued. And they tend to make you also a victim of thematic bubbles. So we saw that in the market cap weighted approach to global indexing, with Japan becoming 40% bubble when its share of the economy was 15%. And of course, we all remember the IT bubble in the market cap weighted approach to US equity investing when it became 37% of the S&P 500, even though its earnings share was something more like 10 or 11%. So we have to accept that market cap weighted indexes do expose you to these thematic bubbles. But what if we could take some of those really good things about passive index investing, the transparency, the objectivity, the simplicity, the low fee, et cetera, but combine it with a couple of basic intuitive investment insights? And that's what we've tried to do. Yes, and this is of course, it's smart beta. And why is it smart? Because you can get better risk-adjusted returns with the way that we've built these indexes. So the intuitive investment insights, really simple. There's 3 of them on our global approach. The first is that we take advantage of the low risk anomaly. And what that means is the following. It turns out, counterintuitive, because we all think that if you take more risk, you'll get more return. But it turns out empirically that actually the highest risky stocks have been amongst the worst performing. So what we do is we take all of the stocks in the S&P Broad Market Index, and we actually kick out the 30% most risky stocks. So we just eliminate those because they have been, they're negative for risk-adjusted returns. So we take out the 30%. That's intuitive investment insight 1, taking advantage of the low-risk anomaly. The second intuitive investment...
Are you phrasing that differently for clients, though? Because that might be hard to understand. Right?
Yeah. Well, I think that, well, what we have to tell clients is that there's a difference between the story and the data. The story that we all believe is that if I take more risk, I'll get more return. But we just show them the data that if you rank these stocks, that actually the least risky among them have had the best returns, and the most risky have had the worst returns. And they can kind of understand that. So we want to remove those highest risky stocks, and that's intuitive investment insight 1. Intuitive investment insight 2 is once we've removed those highest risky stocks, how should we size the remaining positions? If we size them according to price, which is what market cap weighted indexes do, then we've introduced that bias again. So we don't want to do that. Instead, we actually size them according to intrinsic value. And I won't bore you with all the details behind that, but it's basically sizing according to the economic worth of a company rather than the price. And so that's intuitive investment insight 2. And then the third intuitive investment insight, which is quite straightforward, is that we incorporate, when we do the country weighting, we incorporate a measure of GDP weighting. Okay. And so simply put, the market cap weighted country weight of growth in emerging markets in market cap weighted indexes is 12 or 13%. In GDP weighted indexes, it's more like 30%. And we incorporate the GDP weighting into the way that we weight these countries.
How many of your clients, have you already rolled this out to clients?
Yeah, so we've rolled it out with SMP, and these indexes are published on Bloomberg, and we're having lots of conversations with clients around the indexes. I think our clients are searching for credible alternatives to market cap weighted index methodology, and we're having lots of great conversations with them as this is a real viable alternative. And I'll say to you that this we think is always exciting, but particularly right now, because of the much better risk-adjusted returns that are on offer through these indexes, it's actually possible for clients to maintain their fixed income and equity allocations, but improve Sharpe ratios and also get better returns. But it's even also possible for them to reduce some of their fixed income allocation, reallocate it to equity through these indexes, and get better risk-adjusted returns. So very topical for right now, because as we know, people are searching for returns in this environment.
Well, you see that Goldman Sachs reinvigorated the debate 10 years ago with BRIC. We'll see whether the $1.5 trillion in market cap weighted stocks are going to go into the new concept. Very exciting. Kathryn Koch here in Monaco.
My pleasure.
Thank you for being with us, and thank you for watching the FundForum International series.